Sharing my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, today we'll talk a little bit about the surprise that came in on CPI. Really didn't hit the effects until about mid-session and then at the end of the day. But I've got some perspective I want to bring into this. So let's get into today's video. Well, welcome everyone. Sorry for the delay. Appreciate your patience. About everything that could go wrong in the studio was wrong when I walked in here today. So I had to reboot, do a whole lot of fun stuff. Anyway, so in last night's Substack, I talked in the opening opinion, I talked a little bit about what if the CPI comes in, surprises a little bit, and we start to maybe then the tariff is causing inflation story comes out, and of course that was today, and it kind of ground down, and finally at the end of the day everybody got out because they thought, what if PPI confirms this thing? And so that's what's on everybody's mind. But I was flashing back, listen, I'm an old dude, I've been around a long time. I started in the markets in 1979. I pulled out, well, I had it on my screen here just a second ago. Yeah, here we go. Hang on, I apologize. I touched my phone. I put the stats. So I went into and researched it, and I asked for the net changes per month over month, CPI 1980, okay? Just let me give you a couple, and it'll give you some perspective here. I'm sorry, something on my face. I apologize. The January plus 1.4, February 1.4, 1.4, 1.4 April 0.9, 1.2. This is what inflation looked like when they reported real inflation. And the markets, if you go back and we brought up the 1980 action in month to month, maybe on a weekly chart, we could see what it was like back in those days. Inflation was, we saw interest rates at 25% then. And we come forward today. I think, a lot of things are on my, when you get old, you start to see everything. And then you always, I sound like my dad, I guess, of what I'm about to say here. Is, we got a 0.1 change. I just tell you, we got 1.4% in 1 month, multiple months in a row. And, 0.1 is, oh my gosh, the inflation's coming. Listen, we live in this world where I think that, and I'm going to go a little bit. I'm trying to find a way to filter this a little bit, but there seems to be in the world we live in now, everything is a catastrophe, and all of the stuff that we see, it's amazing to me, because there's the type of action we get now are very methodical. In 2020, when they turned the switch off on the economy, that was pretty drastic, and some of the comebacks, but we've never seen some of this stuff. You folks have not seen this. So, try to chill a little bit and not make everything so big. And I think that's what, we get these, I've talked about it over the past several years, stampede markets, and the swarms where they just come after, just coming. The markets are so big now compared back in 1980. Good day on back in those days. New York Stock Exchange volume was maybe 40 million. Okay, and that was a big day, maybe 60 million. But most of the average was like 25, 35 million. That's a nanosecond on the open every day, right? So I just think the way that there is a new psychology, I think, that has evolved, that I've watched evolve over the years. And the one that we have now is, it just seems like when you read the news stories, all the social media and everything's so dramatic, and the end is coming. So I've always tried on this channel and throughout my career just to stay with the numbers and read them and having that perspective is important, I think, and I try to bring that to this channel. And we get the this dramatic stuff that goes on, and just everything feels. I guess it's the social media, news. If any of you have ever read the Reminiscences of a Stock Operator, if you haven't, you should. I used to read it every year. I haven't. Back in probably the first 20 years I was in the market, I would read that, kind of start that book off every year and read that. And it really brings in some perspective, because one of the things that they talked about was the earthquake in San Francisco. It took multiple days for the effects of what was going on with the companies and who was damaged and all of the stuff that was going on around the San Francisco earthquake. And I actually used to work in a building in San Francisco. It was the only building standing, Mills Tower. You can look it up. And it's standing in rubble, and this one skyscraper, 28 stories, was still standing. But anyway, the reason why I bring this up, it just kind of triggered me when I was looking at some of the response, and the markets are pretty muted. We're down 0.25 right now. I think it was a 0.4 move yesterday, earlier today. So I guess it's interesting to put a perspective on, is the sky really falling? And the sky really isn't falling. And but if you read, I looked at a couple of stories and the way some things are being framed. It was like, oh, here we go. And if CPI, and my point of all this, if PPI comes in tomorrow and it upticks the same, then you're going to see another level. And we have something today, obviously, the algos, the social media. You got, literally have people searching through Twitter, looking for stories, trying to build market sentiment and trading models and all types of stuff off of that. And that's fine. I mean, but I think the interesting thing is those numbers were big back in those days, and we did get some big percentage moves and things. Everything was way different. And I just kind of wanted to bring in a perspective today of, what's really going on. Probably isn't as big as it's made out to be. And I got to keep going down this trail for just a minute. I remember everybody was going, the banking, when the Silicon Bank went down, everybody's, oh, it's another banking crisis. And I'm like, no, it's not. It's just one bank. It's a couple banks with some issues. And that's why the FDIC, that's why there's other entities out there to backstop, including the Fed. I was on Mario Nafal's Twitter space with a bunch of folks, and they let me speak. And I said, listen, all they have to do is open the discount window, and this thing will be over. While I was speaking on Sunday, it was a Sunday night, the Fed came out and said, we put a special discount window together for this. Problem solved. But yet the rhetoric around that, the whole banking, it's another 2008 banking crisis. And I'm like, no, it's not. Were there issues in liquidity and things in the banks? Yeah. That if you were to go, I had a old friend that used to be a bank inspector. He would go around, he was a state inspector, and go around, and he used to tell me stories. If you could see what goes on behind a lot of these small regional banks, and the big ones just are the same thing, only exaggerated. You would never put a dime in a bank, okay? Especially credit unions are the worst thing ever made. The governance inside, everything for the most part, not all, but there's some really bad, risky banks out there. And that's what the FDIC backstops. And the only reason why there's not a run on a bank is because people don't want to believe those things are going to happen. They know that if everybody runs on the bank, that we're going to have other issues. So I guess I'm not sure why. I'm just coming up with this thing, getting ready for today. I'm just thinking about the perspective of when things happen. Is point 0.1 really something to be concerned about? Now, if it was 0.3, 0.5, like I just showed you, I mean, those are crazy numbers. 1.5, 1.4. There was one that was 1.9 in one month. Month over month changes. So anyway, so let's come down to earth. Let's talk about what's going on here. So I think, and I've been talking about for months that it's going to take 3, maybe 2 quarters to find out if there is any effects about anything that's happening. And it looks like, I think in Indonesia, there was some kind of deal I saw Trump talking about a little bit ago that, they've got some kind of deal and they're going to be at 20%. Everybody for the first time, U.S. is going to have tariffs on everything. And by the way, if they don't work, why does Europe use them? Why has Europe used them since World War II, really? And going back to the Marshall Act, all of this stuff, folks. And so the U.S. for the first time there's going to be a toll gate to come in and do business here, unless you want to build them here. If you want to build your product here or invest here, then you can get a break. And so I think it's going to be interesting to see how far this goes. But for right now, it looks like a win. But I think market's reaction is probably overdone. And I'm not saying that because I think that doesn't mean, I'm not saying that it won't happen and you shouldn't pay attention to it. I just think we're seeing an exaggeration. And if you look at how the market traded in that last hour today, and it's actually continued with a lower opening. I'm just looking, I have a screen up above here. That's why I'm looking up. That's the case that we're just seeing some follow through. I think people are now taking some protection. And the PPI, then the story on the PPI, if it comes up, it's going to flow to the CPI, and there's a scenario that points out. And I'll put in tonight's Substack. And if you get that, excuse me one second. This is important for all of us. Bear with me here. Bear with me one second. Okay, so so I'm trying to figure out if we're going to have a live stream tomorrow. This text I just got was important to that. So it looks like we should. So I'll be here tomorrow. Thursday may not be the case, or maybe a shortened week. I've got out of town people coming in. So anyway, but yeah. So as we go through this, we get the PPI numbers out tomorrow. Then my expectation will be that we will see probably a further reaction. I was talking, and I'll go through the technicals here in a minute, but the models were suggesting all the algos I talked about look like towards the end of the week would probably hit a peak, start to decline, and that maybe this is the beginning. And we're struggling right around this high, 63 level on the S&P. Mid 63s are starting to become an issue. And I was just talking, I believe it was two streams ago, and in Substack I was talking about the potential of declining back into a 61 handle, maybe a 60 handle, coming down, testing some key support levels. So I still think that is the case there. So let me one of the issues I was having here, and I just want to pull something off the other screen. So I'm still recovering from this technology situation that's going on. I just want to I'm just running the fact sheet for the S&P, so we'll get that running. Sorry for all the craziness, but literally nothing worked in the studio when I walked in, and I have a new computer coming, and hopefully when I get that, I'm going to try to get it done on a weekend, because that's going to be a monster task to convert everything over in this environment. So we'll see how that all goes. Yeah, and Todd, thank you, and Todd, thank you on the Discord stuff. I actually will be reaching out to you to talk to you. But yeah, I have been talking about that echo bounce. Let me do something, see if I can get something on the screen over here. And we can talk about that as well. I just want to see if I can get. I wish there weren't a gazillion. 1 second here. I'm having trouble finding a symbol here. Just bear with me. Will that work? Yeah, that'll work. Yeah, so I have been talking about this. Let's go ahead and put this up on screen. I wanted to bring this up because that's a very good point here. So I've shown this before, and this is the model with the algos, the red dots, all of that stuff for inflation, and this is the median. If yeah, and you can see the projection. I talked about this, I think, in a special report I did a while back on Substack, is that what we're doing this is pushing, going out here. Yeah, going out here all the way to 20. Yeah, out to October of 26. I'm trying to get these numbers straight. October 26, we're looking at potential back to 4% on inflation. So that's an interesting scenario, because if you look at this chart, then it's there could be some interesting inflation coming back, and maybe this is the beginning of this. Let me just see if I can get. I just want to see if I can get, here we now. I don't know what the symbol is right now. Here we go. Let's do it. So this has been, this is a net change of the producer price index. So slight bounce. It doesn't show the same bounce on that other index. I don't think I had a good symbol up. But I have been looking for a bit of a bounce, but really up to maybe 3.18, so like another quarter, half. So nothing substantial from that standpoint. So I don't really see a big bounce, but a little echo bounce. And I'll have to I'll cover this in Substack tonight. So kindlereport.substack.com, you can get it. There's a free 1 week trial. You can try it out. It's $8 a month. But the bottom line is everything what I'm talking about, even with looking at the metrics that we were just looking at, there's not any big bounces or anything coming out that is likely to be, seriously impactful, going to change people's lives. And I can tell you, there was no housing market in 1980, 1981. Interest rates were 25%. It was crazy. What a time to start the market. Start in the market, and it's interesting because never once did any. This is the most, in we'll say, recession-proof business ever to be in, or at least for me, going through 40 years of business, I've never been affected negatively by a recession. I got to be involved in the markets during recessions, but it didn't affect me from a personal income standpoint. So it's been kind of interesting looking back. But the point of everything that I'm talking about today is really trying to bring in some perspective in the markets. And I think if you have a perspective, it will help you to deal with some of the volatility and some of the driving. Like I said, let me just see if I can tie this together, because I'm kind of on a long run rant here, but I want to continue here for just a second. Yeah, that's nice. I'm looking at my sheet that I ran, and it did not run the data right. It's been a rough start to this afternoon, folks. Just everything is not coming in. So yeah. So no, I don't think. Yeah, I'm just trying to get. I've got something else that just broke on me. I'm hating. I'm giving Apple yet another chance here, but I actually think I burned this computer down. I'm having memory issues again right here. I had this the other day where it's freezing up and not allowing me to change something here. Bear with me. I know we've had several issues like this, and I've rebooted, cleaned, done all kinds of stuff here, including bought a new computer. So that looks like that's going to be the ultimate fix here. All right, try something again here, folks. Bear with me. Be patient. I know you've already. Okay. Yeah, at least it unfroze, so we can continue, so we're not going to have that issue. Let me just look at a couple comments you guys have before we move on, then I'll go through all the technicals here. Yeah, thank God inflation doesn't. Yeah, sure, it pumps. 0.1. How about 1.4? That's funny comments, you guys are. Bear with me. Yeah. Yeah, I guess I've been on somewhat of a conspiracy level lately, just continuing to, going off on the earnings reports and how the ongoing manipulation of the markets. And yeah, it's just it's a tough game. So it looks like all right. So let's do this. We're going to go through the WaveTech database. Let's go ahead and do that. We'll go through the rest of the run. It's 25 minutes, so we'll probably have some residual of going on. But just know that try not to overreact to things. But the markets are overreacting, so you have to pay attention to that. I think that the one of the perspectives that I actually had an amazing short trade on today, and I went ahead at I had a target of 76 on the downside, and at 88, I just couldn't handle it. It was too big a trade, so I grabbed it, stuck it in the bank, and only to see the thing go to right to 76, 74 on the downside today. But that was a great intraday reversal that we had, and it kept just grinding around, and then just fell apart. It was a beautiful thing to watch. So let's go ahead and go into the database here. We're finally seeing a break. Look at this, 68%, 68.52. So we're finally seeing a break. We had roughly 2,550 exit signals. I've been talking about this break for a while, so here we are at 68. Next level we're going to watch for 62.58. This is a healthy break here, though. This is not like the end or the top. It could evolve into something like that. But I think probably one of the interesting things I would note here is that you really have the markets trying to reconcile everything. And I thought we were going to get a big bump because last week we were printing all-time new highs. Looked like a lot of stocks participating. The short-term database here was staying in a bullish mode, and it was really good from the standpoint of all that. And I thought we would see an increase in the number of stocks long coming in on the weekly, and we actually didn't. Very little amount of buying came in. You can see it right here. We had 370 versus 210. So we had a net bias to a positive, but nothing material. And if we look here, now we're at 68. So right here, I'll highlight these two numbers right here. You got negative ratios here, and you had roughly, close to 2,550 exits. So that's a decent tranche. And when we get those type of tranches from this standpoint, what you'll get a lot of times, this is probably the beginning of maybe a little short-term correction, maybe moving. We'll go through the technicals here in a minute, but we'll look for maybe the market's coming into one of those slight move back into the moving averages, possibly. I'll see how we trade tomorrow and as we finish this week. But as we come into next week, I should be able to focus in on what type of action we get out of the models, whether on the intermediate level on Friday, because that's really what it's about now. And what I've been screaming. Somebody that was on here the other day telling me I was screaming about a crash. Was not screaming about a crash. What I've been screaming about is that Q3 and Q4 would be a softer market there, and I think that's still a possibility. Will we get recession kind of numbers? I'm not sure. I do still feel like the economy is going to struggle at these levels, and as I said yesterday, it was such a quiet, crazy session. It was like there's nothing out there, right? So now we get the story, and as I mentioned in Substack last night, is just maybe this could change market sentiment. And if point one does it, point one does it. That's okay. The algos are suggesting that we're going to see some loss of momentum, some price declines of some sort. But, we look at how this market's traded from the big announcement on all of the tariffs back in April. We got actually the bottom was made that day just due to that 11% range. And then we watched the market continue to recover back to the 200, then grind into all-time new highs. And I have been screaming also that we'll probably get a rejection off of new highs. And the feeling and thought, and maybe even the way I present it, was it would print a new high and then reject and get a reversal that day. What's happened so far is we're still, we're at 62.70. We're one good day from making another all-time new high. The Nasdaq made a new high today, right? So we're still in that upper end of the territory, but this break in the database should start to materialize a little bit more. We'll see if it would get back to 58%. To be another 10% of the stocks. That would be a fair amount. We're down to 10,000 open positions right now. We were up, pushing almost 13 the other day. So we'll see how this unfolds. For me, this is encouraging. We're starting to see some of the sectors here. Let me zoom in on that. Some of these new trades come in. This is the other thing I was talking about the other day, is that what we're seeing here is, from a sector basis, we're exceeding, like this first sector, 55 of 49, 55 of 45. So we're getting close or have exceeded at least. So let's target and see where these are. So basic materials is extended. Capital goods is extended. And then we also have services, and we're getting there on healthcare. So those are the sectors that you're going to want to watch for further attrition or exits on the database. So when I do the Substack, we want to watch. Right now we're 9 of 12 long on the sectors. That probably go to 6, maybe 5 in this little retracement value that I'm talking to you about as far as this retracement here. So let's go ahead and go to the S&P. It looks like my sheet finally finished, and I'll bring that up here in a moment. Just looking at a couple of stats there. So let's. But here's that grinding that I was talking about. We got the big spike here on April 9th, and then we just have ground up. We're finally showing the red dots were showing us this way last night. Yesterday we did the stream of coming back down into the 40 here, which is 61.19. That number's going, rising up. So I'm thinking 61.50, something like that is probably closer to the number. We're seeing, just looking here, Tuesday next week, maybe starting to see potential peak downward momentum. And the key levels, what we're going to have to do is stair step through and see penetration of the 21-day moving average. Let's see here, that is right now 62.08, so we're still above that. And then the 40 right now, 60.87. So probably closer 62.08, maybe 61 handle is probably going to be the bottom of this. There's no disaster, big giant rollover. When we were over here in February, we got that big rollover. We got these fib projections here on April 2nd, and usually these will take weeks to hit. They hit within a couple of days. We went below Fib target 2, in between Fib target 2 and 3. Then we started this grinding rally. And you can see one of the things that I talk a lot about, and those of you that have the indicators, we never got any big momentum where you saw the trend momentum really starting to build. It's just been this grinding, creepy crawler kind of market where it just keeps going up. We got very low volatility. We had low volume. We had all those things. And I've said this before, just a quick comment, is that when you get in this kind of configuration, those low volume grinding markets, they just go on and on. In this case, it went on for a couple months almost, went through most of June and July, and they're still kind of in that grinding mode. So we maybe with the database breaking down finally, it's still at 68%. It's not like there's 10,000 of the 14,000 stocks still in trend mode. We'll see like I said, we need to watch this. And even if it gets down to 50, I'm back on the database here for a minute, even if we get back to that 58, 62 level, that's still a bullish market. There's still an uptrend going here. So all we're maybe going to do is get a little refresh here. So you're pausing in the market, refreshing. Some of these stocks will recycle and come back in. The cycles on most of our models are on the daily are about 35 to 50 days. And those are market days, so it's like 6 to 8 weeks. You get a little recycling. It takes somewhere between 3 to 5 to recycle. Then you start seeing buying again. So what I just said there gets us into end of August, coming into September, is what I was just talking about. So so let's see here. I've got this sheet run. So give me a second. I'll grab this and bring it over for you. Let's just do a review of the data sheet. Maybe. There we go. All right. So you don't have to see me mess with my computer. Yeah, so we'll see how this all plays out. All right, so this is the data sheet. We'll take a look at it here. 60% range bound, so it's still locked in the range. So far for tonight, 13-point range. Let's see if we can get any kind of projections here to see what's coming out of the data sheet here. So R1 65, 62.87. We're trading 73 right now. I wouldn't be surprised to see this 63.03. There was a number that I was watching trading. We started yesterday. We were at 63.02. Market, ran up pretty good into the 40 handle, then came back down, crashing down actually. But this is a similar type range here, 62.59. Let me just see here what's been the low. 64 has been the low so far. So that's going to be your range S1, R1 right now. We're at 72. So the range is right there. It looks like there's an equal bet. This one, when I'm looking, let me make this a little larger so you can see this. If I can get it right spot. All right, so these levels here, what we're looking at, this is where we're trading at right now. And then 87 R1, this 303, 6303 level, that has been yesterday when we started the stream yesterday, we were trading around 6302. Then the market rallied up. It came down, it bounced off of that, traded back up as high as I think it was 311, maybe 312. And then when we came back down, when we broke that 02, that's where we printed all the way down to 76. So we dropped almost 30 handles in that last hour and a half in this number. So it was a similar setup in the sheets yesterday. So what you look for here is right now there's only a 40% chance of an R2, and on the S2 there's a 50% chance. So there's a slight bias of getting more of the downside bias, not by much, but those are going to be your ranges. And like I told you, when you're looking at these sheets, if you're intraday trading, these are sort of pivot points. If we can break above, that's what's going to happen. Let's see what this logic came up with. So buy above R1. So it's telling you if you break 303, you can trade to 19. So that's the breakout. That's exactly what I was just going to cover. Is you get target 1, then you go to target 2, which is going to be the S2 level. Let's see, R2 level. Yeah, it's going to be 19, so that'd be R3 if you got to there. So and those breakout trades work good. You just want to look at all the PPMs at that time on like the hourly chart. Make sure you're getting confirmation of these trades. And then here's a breakdown. This is a sell below 59 going to 43, which were all the numbers I was just talking about. So, this is when we get into this kind of transitional mode here on the markets. This is where there's some pretty good opportunities to follow through. So all of this is probably going to happen fairly quick. It was interesting last night in London. Those of you know, somebody asked when I sleep. I'm up usually pretty late. It was 4 a.m. my local time when I went down. So I'm trading that London Open and waiting for the New York guys to come in. Literally, some of those guys come in at 3, 4 a.m. In East Coast time. So there's some really, really good traders and people to hang out with during that time. There's some excellent flow trading that's going on there. So I was actually even up for a little bit around the U.S. Open this morning. So I've been it's been interesting overnight, some of the things that are going on. But this sheet will help guide you with the pivots on that R2, and the percentages are going to tell you if there's a little bit bias. So R1, S1 is the range for the S&P, which is 59, 80, 87, and then any expansion of that range. And we do have big news coming out. Typically, we're going to get an expansion. It looks like that expansion be to the downside. So maybe that breakdown trade will happen. Right now, we're kind of in the middle of both of those trades. So anyway, we'll go from there. So let's go ahead and go over and let's get through the NASDAQ. How am I doing on time? Yeah, I should be. I want to go through the treasuries as well. So let's just look at the NASDAQ. Like I said, it is showing that same momentum breakdown, and we're just getting these ranges here. Let me expand this. We're getting these ranges. We're right here setting on the 10-period moving average here. And you can see right here, it's trying to roll. The red dots aren't as steep as they are on there. I talked yesterday about the relative momentum that continues to happen. This is ongoing for, I don't know, maybe a decade now, right? Where the NASDAQ is the leader from a beta and directional standpoint. And so we're looking here at the 22.8 is going to be some pretty good support down there. That's within the market grid. You're looking at S3, 30, 37.57 on here. So we'll see if how that plays out. But we should starting to lose momentum. The 21 is going to be a little more difficult. Let me spin out because you have I am sorry, this thing is all over. Yeah, if I blow up here, you can see the PPM2 is 0.28. And if I ran the data sheet, which I will, it'll be in the Substack tonight. If I run that data sheet, then that's going to give me a high probability of that value holding from that standpoint. So, so let's take a look. Yeah, so nothing unusual in contrasting what I said on the S&P, but the 21 will be that value to watch very closely. 22,648 is that number, and so it'd be 22,830 to about 22,600 can be support. We're probably going to hold there. I don't think we collapse unless somehow the PPI number came in at levels that doesn't make any sense here. But I don't expect that will happen. Yeah. So okay, let's move on. Let's go to let's bring up the Russell got hammered, I think, today. Yeah. So as usual, the Russell is kind of the leader on the downside. We're seeing some steep drop here. We've already broke through the 10, and now we're right on this 21. So this would be the test. You probably use the Russell breaks down, then that will probably lead us down on the downside. This has been pretty interesting. I wish I could get some time on the clock because I've got a bunch of research done on the issues with the Russell and why it's such a dog and has been a dog for a decade. So, but the much steeper pronunciation of this looks like the 40 is going to be in play here. So, like I said, there's not that there wasn't a good trade off the lows, but the money was in the NASDAQ and the S&P from index trade, and there was a decent trade here. Somebody did a good trade and said, well, I made a lot of money. Well, that's fine. You can. I'm just saying on a relative basis, for the same amount of risk you were taking, there were better trades out there from that standpoint. Or maybe if your risk profile is lower, you could do something like this, a little lower beta from that standpoint. But I like to play the high betas. If you're going to play, get in there and play. So let's go ahead and let's go over to the 10-year here. And somebody was asking a question earlier. I just was talking yesterday stream about the 450 level. So we're right up to 450, but let's look at the algos here. What we're seeing is we're getting pretty close to peak momentum. I was talking about we should get up there. We went through fib target 2, which is 4.45. 4.53 will be the number. There's a perpetual number out there for me, 4.72. A break above that would start to generate some new numbers here from that standpoint. There is a potential swing objective coming here that I'm just making sure I don't have anything there. Yeah, we could see some new fib targets come in and play, but for right now, it looks like everything's trying to peak. So we're getting up at that upper range, and I've been 4.25, 450. And in the best of times, we're going to see 395, 4.25. That's going to be these things are locked in ranges, and the reason why they're locked in ranges is there's probably trillion dollars of, I don't know what the number, I need to find that out, but there's trillions of dollars of 10 years out there. So there's widely held security. They're going to stay for the most part in stable ranges. Takes a lot to move this market, more than a 0.1 increase in CPI, but they definitely got a little jack on that. So maybe there's some more if we get a follow through on PPI. No one knows if it's the same. Is that a confirmation? Is that sentiment going to flow through to the other markets and all of that? Even I haven't looked at Bitcoin in the last several hours, but Bitcoin got whacked as well. So we hit that 121,000 plus number, 121,000 plus number, and now it's reversed out of there. So I'll get to that. What time we got here? Yeah, we'll get through to everything. So let's go ahead and go to gold. So gold still got kind of was down yesterday. Algos are suggesting we're going to get a little bit of a rally here, so maybe that's a confirmation sign of what we've been talking about from the standpoint of the markets here. Let me just look here. Yeah, Bo, thanks for that. I was just looking at a couple of comments. Make sure I'm not. Yeah. I haven't read The Great Taking. I'll have to take a look at that. Yeah, I'll do a quick silver review here, okay? I usually don't, but it's been talked about for last couple. But anyway, we're looking at some upward slopes here. PPMs are trying to increase a little bit. So there's a bit of a positive, and the weekly trends still are in place. So, yeah, you can see a nice focus when you take out all the noise, get a little better. This is looking like we're going to go up, but for the most part, we're in this locked-in range, probably right here around 34, 31 to 30. Probably the best range is kind of down here around 30, 3305, 3300. So that's your range. It looks like it wants to push up. We'll see what happens, but still stabilizing here. So let's do a quick silver look. I remember, this is daily, but we got this. One of the things you want to watch for, those of you with this, if you put the market grid up and you get these RTXLs, we got RTXL. We actually got a weekly RTXL, I'll show you in a minute, on Bitcoin that suggested we'd get 1 to 2 weeks sideways. And we followed through early on, and now I think we're negative from last Friday. We'll look at it here in a minute. But the silver is still losing momentum. Really, it's got a bit different formation. The red dots are up on gold. Silver is kind of down. There's no VIG, as I said. In fact, it's losing momentum. So you're probably looking at ultimately back to this 40, 36, 27, 36.50, probably coming back into that range. All right. I'm going to put a weekly chart up here on Bitcoin. So here is the range. I talked to you about these fib targets up here yesterday. We'll go back and review this on a weekly. But right here, we closed above the weekly market grid, and that suggests that we get one to 2 weeks sideways. And you can see the red dots are flowing us back towards 112, and 112 was the old high. So we got to break out to the 123, I think, 122, 23. We'll look at the numbers. Let's just see what that number was. Yeah, we got to 123, 236, and now we're pulling back, and maybe we come back and retest that breakout point at 112. So there's a pretty big move. We're looking at right now 117,928, and that's a little bit off the low, so it was even further down. So those are big numbers. Change $1,200 off of here, but this is a big range from the standpoint of what's going on and what the data is telling us. This was something I've been talking about on a weekly. Is the weekly still forecasting and potentially into September, October. Not necessarily weakness, but a loss of momentum, which would equate when you're in a big uptrend like this more of a big consolidation range. So we may have seen the high print for the moment. And let's go to the daily just to kind of tie that down. Yeah, so here's the ranges here on the daily. Same thing here, looking like momentum loss coming into the weekend and coming in next week. Nothing big. We did get this spike out of the range, and we got an RTX sell signal here. We kind of went sideways with an upward bias, and then we get the breakout. So it looks to me as we come into the end of this week and coming into early next week, we'll probably see more loss of momentum, but the 10 SMA should be some pretty good support there. Once again, the Substack will cover this on a day-to-day basis, all the micro part of that. So let's go ahead and I'll answer some questions here to see what you folks got going. Yeah, I mean, I think the S&P is trying to top here, and that's what we want to watch. The database on the short-term database, if it breaks through 58%, then we're going to get a deeper pullback. That's pretty much it. Yeah, I guess Peter, you mistook. So it sounds like a funny hearing from a man in an ivory tower. Says don't overreact. Yeah, I guess you must be kind of new at trading, maybe. But yeah, what I was saying is none of those. My job, I was an institutional guy. Never was affected by by recessions. I'm not saying I've never been. I worked in the steel mill going through college. I raised a young family, so I know. I've been around. Looks like a couple more days than you, but yeah, I appreciate it. Yeah, just remember the unemployment rate when it's really bad is 12%. It means 90% of the people aren't affected. By the way. Dang it, William, you ask me that question every day, and I don't have an answer for you. Blockchain is adopted throughout the U.S. financial system. I don't know if that's going to happen. It could. There might be something even better than blockchain. Who knows? We got quantum computing coming up, so that's it. So let's see if there's anything else out here. Yeah, I never have been since 1980. I haven't been affected by inflation. Peter's still on that. So being affected mean I never lost a job. I'm just looking through some comments here. Yeah, so I think I'm still kind of looking at a couple of things. So the bond market vigilantes, I think that was not a big reaction. Like I said, the perspective when I was talking about some of the things that I've seen over the years, and especially looking at the inflation data, point one is not. What was it? R.N. Elliott used to say, "One data point doesn't make a market." So we would need for this to be real on another miss. And you have to understand it's a miss of expectations, right? So everybody's expecting 0.2 and it's a 0.3. So we're actually, this is a really good point. I'm glad you asked the question, because we're reacting to the prediction of somebody who was guessing what the number was going to be, and the average guess, so it was higher than the average guess, and we're reacting to that. And I've talked to you about these earnings and all this stuff. I've worked in institutional research department at Merrill Lynch. I've been a head financial analyst, and people react to the guess of the guess of the guess, right? So it's all it's all perception. Like I said, we have the markets are so big right now that we have people that are there's just masses of people all over the planet. The U.S. markets are the most traded markets, most liquid, most accessible. I have talked to many of you that are in Europe. I know some of the things you have going on there. Canada's got their set of rules, and there's certain things you can and can't do. And the U.S. is pretty open on being able to do that. So if you can trade from the U.S., it's probably the most unrestricted there is. So all right, well, let me look at one last thing, see if anybody's come up with anything here. Yeah. Yeah, we'll see here. I'm just looking at some of your comments. Yeah, I'm just looking. Give me a second here. Okay, I think that'll do it. Like I said, there will be a stream tomorrow. Thursday is questionable, and I will have an answer for you tomorrow on the live stream. But the best thing is, the good news is I'm able to maintain the Substack pretty relative. There are yeah, I don't know what it's going to look like when I get this new computer and have to set that up. Hopefully, I have an old Apple computer and I transitioned to another one. It was pretty much seamless. So we're hoping, cross the fingers, that it will be like that for the new one. Anyway, folks, appreciate everything. Sorry for being late again. I need to get into the studio a bit earlier. I take a step away from the markets when they close for a couple hours. And anyway, it is what it is. Thanks again for watching. Appreciate it. Take care.